Hey tech fans, welcome back to the channel. Today, we're diving deep into a situation that could reshape the entire AI landscape. Nvidia's struggle to stay relevant in China. I'm not just talking about a dip in sales figures. This is about the future of AI chip technology and who will control it. Are we about to witness a seismic shift that leaves Nvidia vulnerable and opens the door for Chinese competitors to rise? Stick around, because the stakes are higher than you think. Forget the headlines for a second. Did you know that Nvidia's revenue from China has already plummeted to half of what it was before the export controls? Half. That's a staggering drop, and it's just the beginning. We're talking billions of dollars potentially vanishing and a massive market slipping through their fingers. This isn't just a business story. It's a tech power struggle with global implications. Let's break down the news. Nvidia, the undisputed king of AI chips, is walking a tightrope in China. They're trying to balance compliance with U.S. export controls, maintain their enormous profits, and, most importantly, stay competitive in the world's largest semiconductor market. CEO Jensen Huang acknowledged on their recent earnings call that China revenue is down significantly. Now, even though we are talking about $17 billion annually, which is 13% of Nvidia's total revenue, further U.S. export restrictions could hit them hard. Nvidia's H20 chips, designed to comply with export regulations, have been their lifeline, potentially generating $12 to $15 billion this year and keeping them in the game. But what if those chips get banned too? That's the billion-dollar question, literally. If that happens, Nvidia could face a massive revenue loss. While their global dominance and the new Blackwell architecture will soften the blow, the real impact goes far beyond just immediate profits. Think about it. China's tech industry is not going to just sit back and let Nvidia dictate the terms. They're already investing heavily in domestic alternatives, and a ban could accelerate that process dramatically. Huang himself has warned that competition in China is intensifying. For the second year in a row, Nvidia has explicitly listed Huawei as a competitor in their SEC filings. Huawei. That's a clear sign that China is serious about building its own AI chip ecosystem, and they're not afraid to challenge Nvidia's dominance. This isn't just about one company versus another. It's about technological sovereignty and control over the future of AI. Now, there's a silver lining for Nvidia. Their stock price has likely already factored in the possibility of further export controls. Shares dipped after the earnings call, bringing year-to-date declines to around 8%. Analysts like Mizuho's Jordan Klein believe the shares have been de-risked, and Citi suggests that China restrictions, semiconductor tariffs, and Nvidia's gross margins might keep the stock in a holding pattern for a while. But here's the crucial point. This isn't just about short-term stock fluctuations. This is about Nvidia potentially losing its grip on the world's largest semiconductor market at a critical moment when domestic competitors are gaining ground. To understand the real long-term risk, you need to look beyond today's revenue. It's about missing out on the future growth potential in a market that's rapidly developing its own AI chip capabilities. This is a battle for long-term relevance. Let's dig deeper. Huawei's emergence as a direct competitor to Nvidia is a game-changer. We're not talking about a small startup nipping at their heels. Huawei has the resources, the political backing, and the ambition to become a major player in the AI chip market. Their advancements in chip design and manufacturing are rapidly closing the gap with Nvidia, and they have a built-in advantage in the Chinese market. Remember, China is aggressively pursuing technological self-sufficiency, and AI is at the heart of that strategy. This means Huawei will likely receive significant government support and preferential treatment, giving them a distinct edge over foreign companies like Nvidia. But here's the controversial question. Is this a fair fight? Some argue that U.S. export controls are crippling Nvidia and unfairly benefiting Huawei. Others contend that these controls are necessary to protect national security and prevent China from using AI for malicious purposes. There are no easy answers here, and the debate is only going to intensify as the competition heats up. So what's the solution? How can Nvidia navigate this complex situation and maintain its position in the Chinese market? One option is to continue developing export-compliant chips, even if it means sacrificing some performance. They could also invest more heavily in R&D to stay ahead of the competition and develop breakthrough technologies that are difficult for Chinese companies to replicate. Another possibility is to forge strategic partnerships with Chinese companies to gain better access to the market and leverage their local expertise. However, this could also raise concerns about technology transfer and intellectual property protection. Ultimately, Nvidia's success in China will depend on its ability to adapt to the changing political and economic landscape and to innovate faster than its competitors. This is a high-stakes game with no easy answers. Now, I want to hear from you. What do you think Nvidia should do to stay relevant in China? Will Huawei be able to challenge Nvidia's dominance in the AI chip market? Let me know your thoughts in the comments below. Don't forget to like and subscribe for more in-depth analysis of the tech industry. And be sure to hit that notification bell so you don't miss our next video. We'll be covering the latest developments in AI, semiconductors, and the global tech race. Thanks for watching. Switching gears now, let's talk about something completely different. Gold. Gold prices have been on a tear, soaring to record highs this year, nearing $3,000 an ounce. But the big question is, are even more gains ahead? It seems crazy, but let's unpack this. Central banks around the world have been scooping up gold like crazy in recent years, driving the precious metal to record levels. Add to that persistent geopolitical tensions, inflation fears, and trade concerns, and you've got a recipe for even higher prices. Gold futures are up more than 9% already this year, outpacing the S&P 500. That's a significant move, and it suggests that investors are flocking to gold as a safe haven in uncertain times. But why is this happening, and what does it mean for your portfolio? Central banks have been net buyers of gold for 15 straight years, but the real surge started after the Russia-Ukraine war. In 2022, they added a record high of 1,082 metric tons, according to the World Gold Council. And in 2024, they added over 1,000 metric tons for the third straight year, roughly double the rate from before the conflict. That's an insane amount of gold being snapped up by central banks. Why? Because gold is widely seen as a safe haven asset during uncertain times. Think about it. We've had two major wars break out in Ukraine and Gaza, a regional banking crisis in the US, and persistent inflation fears. In times like these, investors tend to flock to assets that they perceive as safe and stable, and gold fits the bill perfectly. But it's not just about fear. There are other factors at play as well. Concerns around sticky inflation and rising global tensions aren't expected to disappear anytime soon. And other growing threats, like the ballooning U.S. deficit and protectionist rhetoric around tariffs, are pushing central banks to look for alternatives to the U.S. dollar. As Joe Cavatoni from the World Gold Council says, they're looking at, what else can I have? How else can I deal with my own conditions, as well as the conditions of what's going on a global basis? Geopolitical risk is a major driver. Concerns about U.S. policies, like potential tariffs from a future Trump administration and the ever-growing federal deficit, are leading central banks to seek alternatives to the U.S. dollar and treasuries. Gold is universally recognized and not tied to credit or another counterparty, making it a crucial reserve asset. A survey from the World Gold Council showed that 29% of central banks expect to increase their gold holdings over the next year, citing its role as a safe haven and an inflation hedge. Look at the biggest buyers last year: Poland, Turkey, China, India. They all increased their reserves after geopolitical tensions flared up, especially after the start of the Russia-Ukraine war. Even China has been adding to its gold holdings for months, with tariff fears being a key driver. So, where is gold headed? Many investors are confident that the long-term setup is favorable. UBS recently hiked its gold forecast to an average of $2,900 in 2025, potentially peaking at $3,200 and ending the year above $3,000. Joni Tevis, a strategist at UBS, wrote that it's tricky to chase the market higher and uncomfortable when everyone seems to be on the same side of the trade. But it doesn't make sense to call for the end of gold's bull run just because it's reached another record. Chris Mancini from the Gabelli Gold Fund is also confident in the underlying reasons for gold's advance. He's waiting for a spike in inflows into gold-backed ETFs to confirm the next leg higher, which would indicate that U.S. traders are finally joining the rally. If that happens, he thinks gold could easily rise to $3,200 or $3,300 this year. JP Morgan has even pointed out that gold ETFs saw record inflows recently. Even those who are cautious about gold's prospects don't expect the price to go down anytime soon. James Steele at HSBC believes gold is overvalued on fundamental factors, but sees no reason for a major pullback. He expects the market to stay elevated and for central banks and others to buy on any corrections. So, how can you invest in gold? There are several ways to get exposure. You can buy the actual physical commodity, but you'll need to pay for storage and insurance, and it's taxed at a collectibles rate. Gold-backed ETFs are another option, offering a more convenient way to invest, but you'll have to pay management fees. ETFs like SPDR Gold Trust, GLD, and iShares Gold Trust, IU, are up significantly this year. Another way is through gold miner funds. These companies benefit from rising gold prices, but also have operational costs and risks. However, some gold mining companies offer dividends, providing additional income. Funds like the Gabelli Gold Fund and the VanEck Gold Miners ETF, GDX, are popular choices. But here's the key takeaway. Gold is a complex asset, and it's important to understand the risks and rewards before investing. Do your research, consider your investment goals, and consult with a financial advisor before making any decisions. Now, let's move on to our next story. All right, let's switch gears again and talk about the beverage industry. In China, a new leader is stepping into the spotlight. Kelly Zhongfuli, known as the Princess of Waha, is poised to take over her family's beverage empire, the Hangzhou Waha Group. Her father, Zhong Qingho, was once China's richest man, and his recent death has thrust Kelly into the leadership role. But it won't be easy. The Waha Group is facing increasing competition, and sales have been declining. Meanwhile, another beverage tycoon, Zhong Shanshan of Nongfu Spring Company, has become China's wealthiest person. The pressure is on for Kelly Zhongfuli to revitalize the Waha Group and regain its former glory. This is a classic succession story with a modern twist, as Kelly navigates a rapidly changing market and faces intense competition from both domestic and international brands. Now, let's dive into the world of tech earnings. Analysts are cutting their estimates on big tech, raising another red flag for the market. In a notable reversal, big tech is now contributing marginally to negative revisions for the current fiscal year. While the impact is small relative to their market cap, it's still a significant shift. Financials are now contributing the most to forward earnings expectations. This is putting pressure on overall S&P 500 earnings expectations. Barclays points out that 2025 earnings per share are expected to come in lower than previously anticipated. This is the latest sign that the stock market, which reached all-time highs just last week, could be due for a pullback, especially as the Magnificent Seven is losing momentum. Nvidia is down this year, and other momentum stocks have also waned. Alphabet and Amazon have also shed value. The consumer discretionary and information technology sectors are the biggest S&P 500 laggards of the year. This is a warning sign that the tech rally may be losing steam, and investors should be cautious about chasing further gains. Speaking of tech troubles, let's talk about Tesla. Tesla's stock has been unraveling, and Barclays doesn't expect things to reverse anytime soon. After a strong rally in the last few months of the previous year, Tesla's stock has been on a downward slide. It's impossible to point to a single culprit, but multiple headwinds seem to be working in conjunction. Barclays analyst Dan Levy points to a reversal of technical factors that drove the previous rally, as well as a pullback from speculative assets. Tesla's underperformance has coincided with the broader underperformance of tech titans in the Magnificent Seven. Fundamentals are also in closer focus, with Tesla missing its fourth-quarter deliveries and earnings, and its sales in China being weak. The 2025 volume narrative has been de-emphasized, with Tesla surprisingly alluding to battery supply challenges. Moreover, several headwinds exist to challenge Tesla's self-driving software launch in China, including data security concerns and domestic competition. Barclays doesn't expect the near-term picture for Tesla to improve much, calling the stock's short-term catalyst path limited and expecting soft first-quarter results. However, they see the planned launch of the robotaxi in Austin, Texas, as a potential major catalyst for the stock. This is a critical moment for Tesla, as it faces increasing competition and challenges to its growth narrative. And finally, let's talk about Intel. Intel recently dumped its stake in chip maker ARM amid a cost-cutting push. Regulatory documents show that Intel no longer has any holdings in ARM. The sale potentially raised about $147 million. This move is part of Intel's plan to save billions of dollars in 2025, which includes reducing its headcount and cutting capital expenditures. Intel CEO Pat Gelsinger has called these the most consequential changes in the company's history. Intel has struggled to keep up with growing AI demand and the rapid pace of evolution in the chips industry. On the other hand, ARM's share price has surged this year, and the company is reportedly putting together an AI chip unit. This move by Intel highlights the intense competition and rapid changes in the semiconductor industry. One last quick item. Gaming giant Ubisoft faces possible takeover. With Ubisoft's latest Assassin's Creed game facing delays and independent board members reviewing strategic options, analysts are speculating on whether the gaming giant may finally put itself up for sale. Tencent is one of the more likely candidates that might offer to buy Ubisoft, according to analysts. Ubisoft hasn't told shareholders what it's planning in terms of a strategic deal. In its recent investor update, the firm said it would inform the market in accordance with applicable regulations if and once a transaction materializes. So keep an eye on that story. So, that's a wrap for today's tech news. We covered a lot of ground, From Nvidia's challenges in China to the surge in gold prices, the leadership change at Waha Group, the struggles of big tech and Tesla, and Intel's strategic moves. The tech industry is constantly evolving, and it's important to stay informed about the latest developments. I hope you found this video informative and insightful. Don't forget to like and subscribe for more tech news and analysis. And let me know in the comments which of these stories you found the most interesting. Thanks for watching.